Hello, Mike Gillespie, SalesMax podcast number 28. The sale is on. Yes, sir. The Dow soars 11%, the best day in 87 years point-wise and percentage-wise, and we backed it up today with another 2%. So what does that mean for everybody? Is it safe to get back in the water, or is Jaws still lurking out there? I'm not sure, but I do know it's a lot cheaper than it was about a month ago. The market, that is. Just want to discuss retiring comfortably and remaining comfortably retired. On March 19th, about a year ago, I left a presentation, a podcast called The Economic Clock, where I discussed if 12 o'clock's a bull and 6 o'clock's a bear, what time is it? Because the markets move in cycles, just like the seasons, winter, spring, summer, fall. Just like a clock. Every day they keep going in cycles and cycles and cycles. And if you understand how they work, you can be a more successful investor. So what I'd like to do is I'd like to discuss a couple of things. I did a podcast on June 11th, this past summer, called History Never Repeats Itself. And I talked about the fact that you should probably start raising some cash because the market was getting a little long in the tooth. The fundamentals were getting up there, and it's just a good time to start raising some cash for a rainy day. And then on the 21st of October, I left another podcast called Tesla, Your Retirement Assets. Tesla's the safest car, and I just talked about looking at your retirement portfolio, your retirement assets, and putting an airbag around them with some guaranteed lifetime income, some cash, some money market accounts, take some profits, and start getting conservative. Well, March 6th, just a few weeks ago, does anybody really know what time it is? The old Chicago song, and I was pounding the table that everybody needed to start raising cash in their portfolios, taking profits, and waiting because the market was getting pretty scary. There was this unknown thing, and typically it's the unknown things that spark these bear markets. And sure enough, here we are. In the last month or so, we've effectively had a bear market. And maybe we're up, maybe we're not. But that's what I'm going to talk about today. The sale is on. Have a plan. History never repeats itself. Don't listen to the talking heads. So having a plan, do you have the right financial advisor? There's so many great financial advisors that I've worked with all over the country for many, many years, 35 years in fact. Do you have the right person for you? Do they listen? Are you allocated properly based on your age, your allocation, your attitude, your risk tolerance, et cetera, et cetera? Do you have stocks and bonds and cash, traditional asset allocation, which, by the way, doesn't work as good as it used to, if you will? Do you have real estate? Do you have alternatives? Do you have lifetime guaranteed income, annuities? Do you have insurance? Do you have disability? Do you have life insurance? Do you have health insurance? Make sure you have an advisor that can be conversant with those topics with you. And most importantly, have a written, detailed plan, both a short-term plan and a long-term plan, and a plan the day that you retire. So the day you retire, you can walk in knowing exactly where you are and how you can live. It's a very comforting thing. So if you're within 5 years of retirements, or you're 55 or older, or you're already retired, go out and talk to your advisor about maybe getting some guaranteed lifetime income to help with those guaranteed lifetime bills that you're going to have for the rest of your life. You know, it's not good enough anymore to charge 1% to run an asset allocation portfolio. That's what a lot of advisors have done. You have to be more sophisticated, and you have to be able to plan for these severe downturns in the market. Well, we talked about, having a plan. So have a plan and work your plan. Have it written in detail. Now I want to talk about history never repeats itself, but it certainly does rhyme, according to Mr. Mark Twain. There have been 13 bear and bull markets over the since 1926. And after every bull, it's followed by a bear, and after every bear, it's followed by a bull. It's just the way it is. There's nothing unusual about what's happening right now, even though the talking heads want to make big deals about everything. It's a bull market and a bear market. If you're an investor, be a long-term investor. Listen to Warren Buffett, the smartest guy ever when it comes to investing. It's nothing more than taking an escalator up and having a yo-yo that's going down, up and down, every day, every week, every month. But long-term, over the next 20, 30, 40 years, you're having a trend line that goes up, up, and away. And when we talk about the economic clock, I've talked about it and discussed it before. Real simple. 12 o'clock's a bull. 6 o'clock's a bear. In fact, since 1926, the average bull market has lasted 6.6 years with an average return of 339%. Well, interestingly enough, the average bear market is 1.3 years, averaging minus 38%. I just did some numbers today. The 11-year bull market we enjoyed up until about a month ago returned 339% identical to the average of the markets. Just amazing how numbers work sometimes. The average bear market, 1.2 years. This one's only been 1.2 months, maybe. But down minus 35 from top to bottom. So when you take a look at it, it doesn't feel like we're out of it, but you never know when you're going in or you never know when you're coming out. All I know is you need to understand how it works and don't be panicked up. History never repeats itself, but it certainly does rhyme. And it's certainly rhyming like heck right now. It's normal. It's natural. Just deal with it and stay there. Stay invested. We talked about having a plan. History never repeats itself, but it certainly rhymes. What I'd now like to talk about is do not listen to the talking heads. Go watch Netflix or Prime, but stay away from CNBC, from Fox, from the networks, because everything they do is going to be spectacular because they need to sell ads. So if you're watching Cramer, and I love to watch him because he's entertaining, he's smart, he's got a lot of great insight, but he's paid by the network. It's his job to keep us entertained. And if you're talking to an economist is being paid by an investment management company, an insurance company, a mutual fund company. So everybody's got some sort of vested interest. For me, hey, I don't even have a job. How about that? I have my own company. I don't have a PhD. I don't have a hedge fund. I don't have a TV show. But what I do have is 35 years of bumps and bruises for being in this business and watching some of the best and brightest minds out there. And I just know that if you take the long-term trends and you understand and you're patient and you're disciplined, you can be very, very successful. Have common sense, and you can have a lot of success being an investor and participating in this investment game that we're in. So we talked about having a plan. We talked about history never repeats itself. Don't listen to talking heads. And again, I want everybody to retire comfortably and remain comfortably retired. I don't have any kind of vested interest other than I want to see people happy, successful, enjoying retirement, enjoying their grandkids, enjoying their time together with their spouses, etc. And what I'd like you to do is I'd like you to pass this post on to somebody that is concerned about their retirement, their 401k plan, because they shouldn't be. Because long term, if you're younger, just let it go. You're going to be fine. And if you're older, go talk to your advisor about maybe getting some guaranteed lifetime income. But pay it forward. So what I'd like you to do is call your financial advisor today, tomorrow, as soon as you can, and ask them, hey, do we have any cash available? Because there's some great world-class companies that pay great dividends, that have great balance sheets, that have great products. I'd like to maybe get more invested. It's probably not a bad time right now to start reinvesting in the market. And I wouldn't go all in at once. I would take a third out and maybe wait for a 5 or 10% pullback. And if you get it, you have the third more. Allocate. And if it goes down 20% or more, then it's the bargain of all bargains. And they have some cash available for that. It's called dollar cost averaging. It's a great way to go. So please share this with somebody you want to help. Have a great day, and we'll talk to you soon. Mike Gillespie, SalesMax.